Today we're talking about the difference between mutual funds, index funds, and ETFs. And if you're new to investing, you're probably going to want to know the difference between the three because it's going to save you a lot of money over a long period of time. So first, let's talk about how they're all the same. In a way, they're all the same because they're all funds. A fund is a pool of money that invests in many different stocks that gives you access to many different stocks in one single share. So instead of putting all your eggs in one basket in one single stock, like let's just say Apple stock, right? Instead of buying one share of Apple, you can buy 500 shares, or you can buy 16 different stocks in a mutual fund. The biggest thing that a fund gives you, whether it's a mutual fund, an index fund, or an ETF, is it gives you diversification. So you get diversified, you spread your risk around. It's not as bad as having one individual stock, especially for someone who's new to investing. So let's talk about what makes them all different, right? So a mutual fund is an actively managed fund. So that means that there's a professional managing your money, and because there's a professional managing your money, they're earning a fee. And that's the downside of a mutual fund. What you want to look for when you invest in any sort of fund is the management expense ratio, or just the expense ratio, or the MER. Let's just say a mutual fund has an expense ratio of 2%. If you were to invest $100,000 into a mutual fund, each year the fee to manage your money is $2,000. When a fund is actively managed, what the fund manager is trying to do is beat the S&P 500 in that particular year. So the S&P 500, if you don't know, has returned 8 to 10% annually over its history. That doesn't mean that every single year the S&P 500 returns 8 to 10%. In one year it could return 26%, in one year it could return 10%, in one year it could return negative 2%, but over a long period of time it has averaged out to 8 to 10% a year. In one year, if the S&P 500 did 15%, the fund manager of a mutual fund who's getting paid 2% to manage your money, they're trying to beat that 15% that the S&P 500 did in that year. Now the problem with mutual funds is, well, sometimes they do beat it, but sometimes they don't beat it, and you're paying fees regardless. So that is the downside of a mutual fund, the fees and the fact that they don't always beat the market and they don't always get a positive net return for you. Typically at a bank is where you get pitched a mutual fund because of the commissions that they earn for selling the mutual fund. So that's what a mutual fund is. An index fund is a fund that tracks the index, such as an S&P 500 index fund. So an index fund tracks the index. It has a much lower fee than a mutual fund because it is passively managed. No one is managing it. It's just tracking the index. The fund owns the exact allocation of the index. So you're owning the entire S&P 500 index with the exact same weighting. So therefore, there's no one buying and selling any stocks in that fund. So there's no work to be done to try to beat the market because you are owning the market. So therefore, the fees are much less. An index fund, the downside of an index fund is it's traded only once a day. Pro is the fees actually make sense because you are not paying anything ridiculous because no one is really managing your money. Your money is in the market, which historically has performed at 8 to 10% a year. Now an ETF, the benefit of an ETF and what makes it different is ETF stands for exchange traded fund. So an exchange traded fund means it trades on an exchange. And nowadays when we have discount brokerages, such as in Canada we have Wealthsimple, in the United States they have Robinhood, and there's so many other ones that don't charge you any fees or commissions to trade. On an exchange traded fund, you can buy and sell an ETF, which can also track an index like the S&P 500 for completely free. And you can manage your own portfolio that way and still get the diversification of owning the S&P 500. So I hope that made sense. So I personally invest in an S&P 500 index ETF called VFV, which trades in Canadian dollars. And if you were to do the same thing in US dollars, it would be called VOO. And this tracks the S&P 500 index. You pay limited to no management fees for it. So compared to 2%, you'd be paying 0.09% or 0.04%. So you can see the difference, and you'll see over the lifetime of your investment journey, you will save probably thousands and thousands of dollars by doing it this way. So I hope you found this helpful, especially if you're new to investing, or the lack of financial education is the reason you haven't got in. If you're new to investing, buying individual stocks is very risky. Diversifying your investment where you own a piece of many different stocks with an ETF or an index fund with minimal fees is probably the best thing for you.